PPFAs, I must tell you because I interact with a lot of shareholders, is like the gold standard in mutual fund investing. So what do you think worked for PPFAs?
For us, it's not that much about the returns. The main thing is the downside protection. The only way you make money in the markets is buying low and selling high. And that's what we concentrate on, is to get a good starting valuation.
So it would have been hard for you to take that legacy forward. But what has your biggest learning been since then?
Saying no. I think I learned that pretty early after Dad passed away. I think a lot of people thought that we were susceptible or, we were not very strong. So people came to, very senior people would come and meet me to, and that time I was like just fresh out of the water, if you could say, and they wanted to buy the company or partner. Or
I'm sure you get asked this a lot, but what's your biggest lesson been from your father?
The first thing is, don't work for money, make money work for you. So keep investing, because you're going to get rich only by investing. You're not going to be rich by just getting a salary as such.
Given the way the market is moving, given how things are changing, you think this is a return that one can continue to expect over the next 5 to 10 years?
I think return expectations should come down. Valuations are not very cheap. Valuations are trading above average. So keep that in mind and have like a 12-13% kind of return expectations. I think secret to happiness is having low expectations.
So I want to first understand from a retail investor standpoint, why should one invest in international stocks and how should one go about it? What should the allocation be to their portfolio?
Perfect. Yeah. So I think...
Hey guys, I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet effective and impactful news and views from the best minds in the financial world. Hey guys, welcome to the Money Mindset. Thanks so much for tuning in. Today we're going to talk about a topic which is international investing. It's a much requested topic, especially because of all the volatility that we've seen across the globe. And I have with me someone who was perhaps, the early mover in investing in international stocks, especially stocks in the US through their funds. Neil Parikh of Parag Parikh of PPFAs is with us. And he's, of course, the son of legendary investor Parag Parikh as well. Neil, thank you so much for being with us on the Money Mindset.
Thank you, Sonia, for having me. I really appreciate it.
So, I'm sure wherever you go, what precedes you is your reputation of being the son of legendary investor Parag Parikh and, of course, PPFAs. But how does that make you feel? Because now you're also on your own and you're doing a lot of things. You're growing the business. How has it all been for you so far?
Yeah, it's been great. I mean, now when I look back, in fact, exactly 10 years back, I took over as CEO of PPFAs because Dad passed away in May of 2015. I think the initial years were all about just survival. It wasn't about thinking about growth or any of those things. It's like I knew we had a strong foundation because my dad was very talkative. I mean, at the dinner table, you'd always talk about, oh, this is the way we should handle money, clients. So subconsciously, growing up in a business family, you keep hearing these things, but you don't know until something happens, right? And I remember I was on the plane. So they had an accident in the US, and the next day I was on the plane to see them, and all these thoughts just kept coming to me about what he used to say, the way you'd want the business to be run, and just the value system, which were pretty strong. And I just asked the person to give me a tissue paper and just started writing all that stuff down. And I just got clarity at that point that, okay, this is the way we need to do. We got a great thing. There's no way, you don't need to reinvent the wheel for sometimes, sometimes you just need to just let things go the way it is and make sure you just make the foundation stronger and stronger. And that was about it. And hopefully there's light at the end of the tunnel, which there's always light at the end of the tunnel. And patience was something that we were taught at a very young age. So we wasn't in a hurry to grow or any of those things. Even when we started the mutual fund, we thought that it's going to be a 5-year journey before we start seeing any traction. Reason being, we didn't have any distribution network. We were not bank backed. We weren't a corporate house backing us or a JV with a foreign partner. It was just us, as a family kind of a thing. Like, okay, let's build a track record for 5 years. Let's communicate really well. I think communication was missing that time in the mutual fund industry. We have our AGMs for our unit holders, which was, again, as transparent as we could be, And we said that, hopefully all that works out. And if our performance is more or less okay, we will probably we will be okay. I mean, we'll get probably some little allocation for people, and if nothing else, then friends and family were anyway investing. And yeah, when that happened, we're like, okay, maybe not 5 years, it'll probably take 8 years for us to get somewhere, because after that passed away, it was obviously again building that foundation, building that trust, that goodwill, and saying that this continues. It's not one person, will take it forward, and I think more or less me, the team, we all have worked towards that.
And you've done a
And
great job. I mean, you've
thank
had
you.
what, like a consistent returns of since inception about 19-20% in the fund.
Yeah, it's about 20% since inception.
And, I mean, PPFAS, I must tell you, because I interact with a lot of shareholders, is like the gold standard in mutual fund investing. Especially, I've interacted a lot with Rajiv Thakkar as well.
Yes.
And, the way you guys pick stocks, just your style of investing has been preferred by investors. But I do know that, I mean, 10 years back, of course, it would have been really hard for you to, it was very tragic and it was very sudden, right?
Yeah.
So it would have been hard for you to take that legacy forward. But what has your biggest learning been since then?
Biggest learning, I think couple of things, I think saying no. I think I think I learned that pretty early after Dad passed away. I think a lot of people thought that we were susceptible, or we were not very strong. So people came to very senior people would come and meet me to, and that time I was like just fresh out of the water, if you could say, and they wanted to buy the company or partner, or you thought, so that was the time. I mean, like, I'm like, no, I don't want to do this, So I think that no, I think saying no is actually really important, because you can't say yes. I mean, you can't say yes to everything, because you have to do what's right, and sometimes it can hurt feelings, or you could be looked at somewhere differently, I guess, So yeah, I think saying no, I'm still learning that point of view, but I mean that's ever growing, I mean, in the sense that you only learn to say no with more confidence and more experience. So I think saying no to a lot of things is very important. About people say that you should do this, you should do that, launch this scheme, launch that scheme. I mean, if you have a clear strategy, one thing is that, the other thing is to keep your blinkers down and run your race. Don't look at what the everyone else is doing. I think we learned very easily that, listen, let's just do what we want to do, and let whoever else do what they want to do.
So, what do you think worked for PPFAS in the sense, having this consistent track record of 20% is not easy, especially in today's day and age where there's like an overload of information, right?
Yeah.
What do you think worked for PPFAS?
I think just the consistency in the fund management process, in terms of understanding that underperformance is a given in this industry. Short term underperformance is given. You're managing public money. Don't take risks. Don't do what you wouldn't want to do with your own money. So sometimes we don't find opportunities. We're okay to be in cash. I think for us, it's not that much about the returns. The main thing is the downside protection. I mean, if your downside is protected well, your upside, even if it's moderate over time, because the downside is not that down, the upside is pretty moderate, you get superior returns, So the, what you call the risk adjusted returns, So I think we concentrate a lot on that, let's just use common sense and do it. And yeah, I mean, people say, oh, I've given you money to be 100% invested in equities. Why the hell are you
In cash.
in cash and all that?
You've got a lot of flack
Yeah,
for that,
we've got
right,
23,
recently?
24% cash even right now as we speak.
Yeah.
And our whole thing is that, look, you can't, if there's something, the only way you make money in the markets is buying low and selling high. And that's what we concentrate on, is to get a good starting valuation. And that starting valuation will at some point come, and even if you're in a bull market, bear market, there are always opportunities. You just have to be patient about that. So I think we're pretty patient about those things, about how we manage money in terms of the stock selection process, and also being patient about getting those stocks at a valuation which is okay with us,
So you're sitting on 23% cash at the moment.
Yeah.
You feel that there could be a big sell-off that could come in the next 6 to 8 months, and then you would perhaps deploy the money?
So we don't predict what's going to happen in the future, and if there's going to be a crash, no crash. I think what we are looking at is from a bottom up perspective, stock specific. If a stock is attractive, and just let's just go back in history a little bit. Even in 99 2000, when there was a huge bull market, and that time all the IT stock ran away, but you had the pharma stocks and the FMCG stocks, which were the old economy stocks, which were available at a pretty good valuation. So if you were there, then over time you would have made money, but that 1 2 years you probably would have underperformed, which is our point of view, is that there will be some point of underperformance at some point if you're not going with the most hyped up stuff at the height of a bull market. 2007-8, the same thing, right? I mean, the IT stocks were amazing to buy at that point, but if you were not in power, real estate, infrastructure stocks, you would have massively underperformed that 1 year. So we try to stay away from excesses, and we try to find opportunities where in neglected stocks. So we are finding that we're buying at the margin, whatever it is. So wherever we get opportunities, we are buying. It's not that we're not buying, but yeah. So as and when the valuations seem attractive, we'll probably buy.
So stay away from excesses and look for opportunities in neglected stocks.
Yeah.
Interesting. You're
Yeah.
finding any neglected opportunities now?
Yes. There are pockets of opportunities that we are finding, and we are deploying there.
Okay. So my aim for this, conversation was about international investing because, you guys at PPFAS were the early movers in investing in US stocks, also leveraging on the US tech boom, which
Yeah.
we've seen in the last 5-7 years, right? And now through Gift City, you all are launching some funds as well. So I want to first understand from a retail investor standpoint, why should one invest in international stocks and how should one go about it? What should the allocation be to their portfolio?
Perfect. Yeah. So I think 3 or 4 reasons why you should look at international stocks. First one, the main thing is to reduce the risk in the portfolio. It's not about the returns first. It's about reducing the risk. And the risk is today, if you're invested 100% in India, you are taking a big country specific risk. And we've seen that, we had a demonetization event. We have border tensions with our neighbors, China, Pakistan, and we have elections, which will hamper India. And having some portfolio of your money outside India will protect that money. So you are not taking that country specific risk, you're diversifying that risk. So a demonetization will not affect a Google or a Amazon abroad. So some part being away from the country will help you reduce the overall risk of the portfolio, will generate a better risk adjusted return for you over a longer term. And also markets don't go in tandem. Like 1 year US will be up, 1 year India will be up, 1 year some other country will be up. So everything doesn't go in tandem. So having, again, spreading it out will give you that risk adjusted return. That's one. Number two is that India only accounts for 4% of the market capitalization of the world. In essence, 96% of the opportunities are outside India. So why to restrict yourself only to 4%? Let's look at something else. Third is that today, however you think, research, as a research analyst, when you're researching, you have to look at global companies. For example, you're looking at Tata Motors, you have to look at Jaguar, Land Rover. You have to look at what the competitors are doing. You're looking at even Maruti or anything. You need to know what Toyota is doing. You need to know what Hyundai is doing. In essence, you are already kind of looking at these companies in some form or way. So get the research deeper, look more into these, and then you can probably find more opportunities, probably better opportunities abroad than the one that are in India, or you can get more insights about our own companies. So research becomes much better by looking away from the country and not only looking at our companies, but looking at other companies outside the world who are competitors to our company, to our companies. Fourthly, is that today, if you want to invest in AI, chips, EV companies, like there are not too many opportunities here, right? I mean, for that, if you want those kind of innovative companies, you have to look outside the country, and there'll be industries which are not very well developed here, like AI and stuff. So you have to go abroad to look at those companies and be at the forefront of those changes. And that's why you need to invest abroad. And lastly is, look, India is getting affluent. We are carrying iPhones, we are watching Netflix, and we are carrying Louis Vuitton bags, right? I mean, where is all that money going to these stocks, to these companies? So you might as well look at
Might
these
as well
wherever the
invest in
consumption
them.
is going.
Yeah,
So these
yeah.
are the few reasons why you should invest abroad.
So, what's the best way to invest in international stocks? Is it through mutual funds? If yes, is it through? Because I do know that you guys are also looking at launching a couple of new funds through Gift City.
Yeah.
Tell us a little bit about that.
So, in essence, you have three options to invest abroad. One is through the local mutual fund route, which was going well for the last few years, but there was a limit of 7 billion for the whole industry, that we can't invest more than 7 billion in global stocks. We unfortunately hit that limit about 2.5, 3 years back. In 2022, we hit that limit. The hope was that this will get revised, because 7 billion is too less, I mean, if you just do a little mathematics, 7 billion limit since 2007. So it's on historical ways to it's 7 billion. We have 1 billion people. That's $7 per capita, where you're giving 250,000 LRS limits per person per year. So this we thought would actually be revised. So far, it's not been revised, and don't know. I mean, there's a big uncertainty if it will be revised. So that tap is closed, unfortunately. The mutual fund tap. So now you have two options. One is you can invest directly by yourself by opening a brokerage account outside the country,
Through
or
the LRS route.
through the LRS. Now there's only LRS route available. Either way, through the gift also it's LRS.
Okay.
Or if you do it by yourself through a platform, also it's LRS. And through the Gift City now, the good thing about Gift City is we have started retail funds in Gift City, where the minimum is $5,000 and $10,000, which is actually very good. Otherwise, if you had to invest in some of the AIF and the PMSs, the minimum is 75,000 to 150,000. So it wasn't accessible to everyone. Today, it's very accessible. And $10,000 limit is a very interesting kind of figure, is because TCS starts at 10 lakhs.
The tax deducted at source.
At source, so 20% immediately goes there. So if your minimum is less than 10 lakhs, then people don't need to give that TCS. Their whole money will be invested in that, and that 20% won't be deducted, which is not giving you any money. So that's...
So you're saying now, if the minimum investment is around $5,000, which is around 4.5 to 5 lakhs, and you don't have to pay tax deducted at source on the money.
If you
Through
invest
Gift
more than
City.
10 lakhs, then you have to.
Okay, through Gift City.
Through Gift City.
Okay.
And so let me just clear this point, because LRS also includes investment, your trips abroad, your education for your son or daughter who are studying abroad. So all this is included in LRS. So if someone is not doing is not traveling too much, often outside the country, or doesn't have too many expenses out of the country, then if he puts in whole 5,000 or 10,000, which is less than 10 lakhs, we will not have TCS on that part.
Okay. So the two main routes to international investing, one is through the LRS route, where you do direct investing, and one is through Gift City, you're saying. Now tell me a little more about Gift City investing, because you are planning to start a couple of funds there as well. I think 2 outbound funds and 1 inbound fund. So just tell us a little bit more.
So we already have a PMS running in Gift City for outbound. This is for advisory route for HNI clients who want to invest abroad, and we are advising them on that part. So that's one. But we are also going to launch 2 passive funds outbound, which will hopefully will start in next month or 2. So we're very near to the launches of those funds. One outbound active fund, which is basically we'll be picking the stocks. The outbound passive fund will just be feeding into another a passive fund like Nasdaq and S&P, and you'll get the returns which are which the underlying index gives you. And the fourth one is an inbound fund, which will feed into our Flexi Cap fund. And this will be helpful for NRIs and foreigners who want to invest in India, because in fact there are 2-3 big advantages of that. So you can obviously invest in a mutual fund directly, but for that you need a PAN card. You need to
KYC.
you need KYC, you need a PAN card, KYC, you need KYC, so you need to
Yeah.
do either way
Yeah.
for even regularly. Also, you need to convert your currency from whatever currency to rupees and invest through the rupee. And you have to do your tax filing in India. Okay, so there were three things. But when you do it through the Gift City route, you can invest directly in dollars. You don't need a PAN card. And you do your home country taxation.
Oh, that's interesting.
So that's interesting. The only
So
route.
as of now, until now, NRIs cannot invest through Gift City. It hasn't started yet.
It has started.
Okay.
It has started.
Okay.
There are funds who are doing that.
Okay.
Yeah.
So this is now what you're saying is through your fund.
through my fund
Yeah,
will
yeah,
start.
yeah.
So there are other funds who are already doing it.
Okay. Okay.
So the only roadblock here was that the onboarding part of it, because you couldn't do video KYC, you needed in person, and paperwork was a lot, it was an operational hassle actually, which is getting easier and easier. So in fact, just 2 days back, I think they allowed video KYC, and that happens, it'll become much easier for foreigners and NRIs to invest in the country. So we'll get a lot of money, I think.
So and there's a lot of interest. I mean,
There's a lot of interest,
every
exactly.
time, I do an outreach to like people or to retail investors, I get a very common question that how do NRIs invest in
Yeah,
India?
yeah,
What is the
yeah,
route? So
yeah.
you're saying currently if NRIs have to invest for all these years, they have to do a lot of these regulatory processes,
Yes.
KYC, and they have to convert their dollars
through the
or
mutual
whatever
fund route.
through the mutual fund
Yes.
route. Yeah. And then of course even like taking the money back would be a bit of a
Then
hassle.
again, you have to do exactly.
Yeah,
Then you
okay.
need a NRE, NRO account and all those things. You can't. Here you can link it straight to your bank account in foreign bank account.
Through Gift City.
Yeah, through Gift City. So you can invest it through your bank account. Here, if you had to invest in the mutual fund, say in our mutual fund, if somebody is abroad has to sit, then then the NRI needs to have a NRE or a NRO account. You get away from those things. So all those operational hassles you will become much easier. So
And are you seeing a lot of interest from NRIs, from people living abroad, or not yet?
yeah, so I've not got actively talking about this. This is the first time I'm actually talking about it. So yeah, we do get feelers. And that's one of the reasons, because we got feelers. We're like, okay, this would be something interesting for NRIs and foreigners to invest in the country. So even foreigners can invest. Foreigners was a very big challenge to invest in a mutual fund. So now they will be able to also invest through
Gift.
and which will actually feed into our mutual fund. So they will get the mutual fund allocation.
Okay. So coming back to investing in international stocks, right? You were telling me that you have two passive funds that are outbound and one outbound active fund where you all will be individually investing in stocks. What is the state right now? Because we're at a time when the US markets seem to have peaked, and I understand that your large investment will be in the US itself, or are you looking at other markets like China, South Korea as well?
So our when we look at international investing, so our strategy, everyone will have their own strategy. I'll just talk about our strategy. Our strategy is to get globalized businesses. When I first spoke about country-specific risk, now I don't want to invest in a country which is in a company which is only catering to that one company, right? I mean, a small or a mid-cap stock of that company will only cater to that. So we want globalized businesses. So again, today, when we everywhere in the world, everyone's watching YouTube or using Google Maps, and so it's a diversified kind of a business in the sense that it's globalized business. So one thing is that we want globalized businesses where things are where sales are happening throughout the world. So again, Nestle, everyone's eating Nestle chocolates or something somewhere in the world, right? So that's kind of globalized business. Again, some of the luxury brands, Louis Vuitton or something, their sales are happening everywhere. So we want globalized businesses. Then we want countries which have a strong rule of law, where balance sheets we get in English, where minority shareholder rights are taken care of. So that would be North America, Western Europe, and developed Asia. So we don't want to go too exotic into countries. Even a China or something, though, I mean, it's a big country, but I mean, there's not too much confidence about the rule of the law, So we'll stay away from some of the smaller countries. We'll just concentrate on, like I said, the developed
North
countries,
America.
North America.
Because a lot of people are now talking about investing in Chinese ETFs and looking at the
Yeah.
China. You don't want to.
No, we don't want to do that.
Okay,
No, we
okay,
don't want
okay,
to go
fair enough.
anywhere exotic. I mean, we'll stay with
What you
tried
know.
and tested,
Yeah.
where we can get globalized businesses. I mean, you're not
Yeah.
going to get globalized businesses as such in China.
And where perhaps you'll get access to data also, right? It's
Yeah,
hard to get.
and also I mean, you can hear them talking English. I mean, I think you
Yeah.
get lost in translation if you're investing in Thailand or something like that. All your balance sheets and communication you'll get
Yeah.
in Thai language. Then
Yeah.
you have to communicate. Then you have to translate it, and
Yeah.
you get lost in translation.
Yeah, yeah.
It's a waste of time. Also, I mean, and again, if you just take these three markets, like I said, North America, Western Europe, and developed Asia, it covers most of
Large
the
part.
world. Like I said, India is 4%. You add these three, you are mainly more than 75-80%. Yeah, so
Correct.
it's okay. I mean,
And where do you see maximum potential in terms of sectors? I mean, of course, like you said, right? In India, if you want to participate in, say, AI or deep tech, there's not much.
Yeah.
But globally, where do you see large amounts of money going in terms of sectors?
Yeah, so we are still very bullish on the tech sector. I mean, if you just saw some of the results that came of Amazon and Google and all, fantastic results, even at that bigger size, they're growing at 25-30%. Where if you see our results, some of our results, I mean, there was low single digit growth kind of a thing. So these companies are at the forefront of digital explosion, in terms of AI or EVs or driverless cars or what have you. So we are looking at that space, definitely the tech space, where you don't get the equivalent companies in India. EV chips, all those things, where we don't get it here, we'll get it there. And again, auto company, we are actually researching quite a few companies. We got about 200 companies in our watch list that we are researching on. So as
you
and
don't
when,
think that some of these sectors have peaked out, like say tech in the US or even chip manufacturers like an Nvidia, for example. You don't think any
Yeah.
of these, or semiconductors?
So again, stock specific, each company. I
Yeah.
mean, we can't go into each company, but there are pockets of opportunity even in some of those sectors. Some of the companies that we have actually in our portfolio, which I can talk about in the Flexi cap. So we have 4 companies: Amazon, Google, Facebook. Google as an alphabet, Facebook, and Microsoft. Now we are quite okay having these companies, and if we had probably a chance to invest more, then hopefully at this time we might have even increased allocation to those companies. So I think it's stock specific, but I think opportunities will be there.
And you all got in early into this
Yeah.
whole tech space. So you
Yeah.
all kind of, from a valuation parameter, you all kind of found good value in.
Yeah. I mean, valuation is still comfortable.
Oh, you think so?
Yeah,
Okay.
at least in some of these stocks. So
Okay, interesting.
Yeah.
So, as a retail investor, what percentage of one's portfolio should be in international stocks?
that's a little tough question because, personal finance is very personal. So each one will have its own needs, in the sense that if your kids are going abroad to study, I would say have more allocation to global stocks. Someone who's middle aged or who don't have those kind of ambitions of building assets abroad or sending kids abroad, have a smaller allocation. But I would say about 15-20% on average should be good enough. Yeah, but have some, my point is, have some allocation abroad.
Okay.
And today it's accessible, will be more accessible to retail clients. So it was accessible obviously to HNIs, but like I said, the minimum used to be 75,000 to 150,000. But if it's $5,000 and $10,000, then I think a lot of participation can come in.
Absolutely.
Yeah.
I mean, that is like a big game changer, I
Yeah.
think, as far as international
Yeah.
investing is concerned. So, in terms of taxation, you were telling me, but can you just elaborate a little bit more? So, for suppose I am investing through Gift City into international funds, what does the taxation look like?
Sure. So there are 2 structures, I would say, in Gift City. One is your Gift City fund is directly investing in stocks. Okay. So there, one of the disadvantages is that that fund will be taxed on churn. By churn, I mean by every sell will be taxed. You will have also withholding tax of 25% for your dividends. So that makes it slightly less efficient. I think there's also talk that they will try to scrap this, but that's obviously, we don't know if it's going to happen. But that's why everyone else is looking at a feeder fund structure. A lot of people are looking at a feeder fund structure. We are also looking at a feeder fund structure where you collect all the money in Gift City in your fund, and then you invest in then you feed all that money into a master fund or an umbrella fund, which is in a jurisdiction where the taxation is much better than in Gift City. So, for example, for us, what we think is the best jurisdiction is Ireland. So we will launch our funds through UCITS, it's called. So it'll feed into a UCIT or a Irish fund, which will be a passive fund, or we'll start our own active fund over time there. What happens here is that here the taxation is not on churn. So they, like a mutual fund, how it's tax exempt from buy and sell, you're not taxed on buy and sell. Here also in Ireland, you're not taxed on buy and sell.
On the churn.
And your dividend withholding tax is only 15%, not 25%. So it becomes a better compounding machine, in my view. It becomes a little efficient for the investor. At time of redemption, say a client wants to redeem now, so we will put a redemption in the master fund. They will give us the proceed in our Gift City fund. The Gift City fund will pay taxes. Okay, so the client doesn't pay taxes. The fund will pay taxes, which will be above 2 years will be 12.5%, which is same as your mutual fund, short term and long term. So long term capital gains will be at 12.5%, but less than two years will be at the marginal rate, and the marginal rate would be 43%, even if the person is in the lowest tax bracket, because the fund will be paying the tax. So it makes sense if you want to invest in such funds to have a very long kind of. I mean, we keep saying that. Look at it from a 5 or 7 year perspective. Equity is a 5-7 year product. So at least 2 years, please don't redeem your money for 2 years, because you'll have a big tax hit.
And what about the PMS that you have? You have a PMS structure that invests through Gift City as well, right?
Yes.
What is the taxation on that?
So there, two taxations there. So there'll be inheritance tax. So so one of the other advantage of a fund structure is there's no inheritance tax. And inheritance tax, let's just take US for example. If anything more than $60,000 is subject to inheritance tax. So for example, you invest $60,000 through yourself, and a PMS is basically your own account, right?
Correct.
It's not a fund structure. It's an individual account. So you will also get hit by inheritance tax there. So the inheritance tax is as high, it is 40% of your overall assets. So if you've invested 60,000, say, in the US markets, and that goes to 100,000, and God forbid something happens to you, the US government will take 40,000 of that, 40% of your, not on the gains, on your total value.
On the total value.
So even though you made plus 50% returns, in the end, when you get in your hand, it will be 0% return.
So then how does it make sense for me to invest in the PMS through Gift City? I'd rather just invest in the regular outbound passive fund, no?
Yeah, it's similar. I mean, yeah, it's similarly. So people want different structures. They want to get into different asset classes. A fund will invest through its own strategy. There's no way to say, customize this for me or something. If you want customization, you want certain asset classes, or you want certain stocks in your portfolio, or some way you want to do it, then you have to go through the PMS route if you want to customize, or an AIF route also is possible.
And if you're expecting outsized returns in a particular asset class and you want to invest.
Yeah.
Okay, interesting. So,
and people already, some people already have money outside the country, which are already invested. Now, the thing, if you do it by yourself, okay, there are a lot of operational hassles, a lot of paperwork, a lot of tax filings to do. If you don't have the time to do it, one of the reasons why people come to the PMS is because we take care of all those things. You don't have to worry about all those ancillary things, And then we can advise them also, okay, we are liking this, we're liking that, or we should invest here. And then it's up to them if they want to do it.
But this inheritance tax thing is a big game changer, right? I mean, it's a deal breaker actually, if you look at it.
So the fund structure, you don't get inheritance tax. Only in your personal, if you do it
through the PMS route.
PMS route, or like we were mentioning, what is the other, using your LRS money to do your own.
So through the LRS route, you get
Of
inheritance
course,
tax? Oh,
yes, yes. So the fund structure is important because you get away from the inheritance tax there. You don't have
oh.
inheritance tax there. Yeah,
Interesting. Okay, so you'd rather do the fund structure
you'd
than
rather do
and
the
not,
fund.
I mean, if you reach that
Yeah.
threshold. Got it, got it. So in your PPFAS domestic fund, you have a allocation to US stocks, but now that limit has been hit, so you all don't have any fresh investments there.
So if we get dividends from these stocks, we can reinvest them into we can buy stock, the same ones or different ones. So yeah, so in essence, we can't take out more money, we can't send more, we can't remit more money abroad. Whatever little buying happens is through the dividends. So yeah, in essence, at the we had about 30% allocation to the in our flexi cap to the overseas stocks, which has come down to about 11-12%.
Okay, that's unfortunate though. I mean, because a lot of people, I'm sure you get this feedback a lot that, I wish there
Hey,
was a higher
yeah, yeah, we wish
exposure
to.
to the US, right?
We wish to if the limits
Given the
open.
kind of like surge that the US markets have seen over the last
Yeah.
couple of years.
Yes, yes, yes. And also, it's just about diversification, right? Like I
Yeah.
said, the main thing is, yeah, returns would be there. And like I said, there'll be periods where US would be better and there would be periods where India would be better. But when you have both these, then your risk becomes less and your risk adjusted returns become more
Yeah,
over
yeah.
time. So it's a smoother ride, basically.
Absolutely. And even if you have like goals, which are like personal finance goals, like we were discussing, right? Building assets abroad, sending
Yeah,
your children
yeah,
abroad,
yeah.
or just maybe some people want to retire abroad. So all of that will
All
help
of that help.
with international
Yeah,
investing.
yeah.
Got it. Coming back to your main baby, which is the PPFAS, the Flexi Cap Fund.
Yeah.
It's been a very good journey for you so far, or 20% return since inception.
Yeah.
But given the way the market is moving, given how things are changing, you think this is a return that one can continue to expect over the next 5 to 10 years?
And I think return expectation should come down. I think that's the communication we give to people, all our investors. And we have a unit holders meet in like 2 weeks on 22nd November. So we'll probably talk about that there also. That I think, look, last 5 years since COVID, we made a lot of money. Everyone's made good returns. Uh, Valuations are not very cheap. Valuations are trading above average. So keep that in mind and have like a 12-13% kind of return expectations. I think secret to happiness is having low expectations, right? So have low expectations. So you have 10-12% expectation, you get 13-14%, you'll be very happy. But if I say, oh, expect 18% and you get 15%, you'll be very sad. So have low expectations and hope for high returns. But I think 12% kind of return expectation should be there.
So your motto is under promise and over
Over
deliver.
deliver. That's kind of, hopefully that's that's something that you'd like to do.
But like, is it more a moderate expectation of returns because of how the environment is, or has it become tougher to now find value in this market?
So I think in every market there are pockets of opportunities for sure. So we are finding some opportunities. It's not like press the button and buy everything like how COVID was. So in fact, in COVID, we were sitting on 14% cash when COVID hit. And there things fell quite dramatically that first month. That 14%, we used up all our cash in that 1 month and got it down to 1%, 1-2%, what is the bare minimum you wanted to keep there.
And that was a
So,
great decision.
yeah, so I think opportunities will come. We are not this thing, like I said, we're like decently patient people. So we'll wait for good opportunities to come because the starting valuation really matters. So if you invest when valuations are low, over time you will get good returns. But there are times where you have to wait sometimes,
Yeah.
to get those opportunities and not be too trigger happy about those. So.
Yeah. The reason I'm asking you about your return, about what expectations people should have from PPFAs, is because now the AUM has become large, right? 1 lakh crore of the fund. So as the fund size grows, I think expectations of returns go down because it's harder to, I guess, outperform as the fund becomes bigger. Is that a common grievance that you get?
I don't think that's right, and I'll tell you for one or two reasons. From a mutual fund perspective, stock limits are at a fund level, not at a scheme level. So from a fund level, I can only buy 10% of, say, a particular stock, or 5% of the paid up capital of that particular stock. If I have 100 schemes or one scheme, my limit is the same. So if I have 100 scheme, I will have to have 0.10 or whatever allocation to that stock, So one thing is, if you want meaningful allocation to one stock in that, it doesn't happen, So in our Flexi Cap, if you want 10% of one stock, we can actually buy all that 10% in one scheme, So again, it's like slicing and dicing it, right? I mean, cut the pizza into, have the full pizza, or cut it into like 15 pieces, the number of pizza, the pizza is the same, So I don't think that really affects, in terms of allocation as such. What does affect, there is one thing that does affect, is that we can't take very meaningful position in the very small companies. So one thing we are looking at is to having a longer tail of small cap companies. So today we can't buy like something which will be 2 or 3% allocation in a small cap. It'll be like 0.2, 0.5%, because obviously the size of the scheme. So you'll have longer tail of smaller cap stocks. I mean, that's the only thing that changes. Otherwise, even the fact that our markets are getting deeper with the IPOs and so many things coming up, so much market participation coming up. So there's no problem buying large cap and mid cap stocks as such, And listen, our AUM, equity AUM is like 1 lakh, whatever, 20, 30,000, There are far bigger fund houses than us. They're managing more equity, 7, 8 lakh crores of equity, So, like I said, it's at the fund level, not at the scheme level. We are like 2% market share of the equity AUM of the country. So, I don't think that's a challenge so far.
But some of the larger fund houses also struggle with outperformance, actually. They give moderate returns, but as the fund grows larger and larger, I think their ability to take outsized risks become less.
Um, I don't know about other fund houses as such and their thinking, but we are not as such facing it at this moment. Like I said, the only challenge is to get meaningful allocation to smaller cap. I mean, and you do get that allocation, in the sense, but it looks like a very small percentage in your overall portfolio, So at 1,000 crores, if you buy 500 crores worth of a company, that's the allocation. Here also I'm getting 500 crores worth of allocation, but on a 1,20,000, which will become like a point something, 0.2, 0.3, whatever calculation, So we're getting the allocation. It just doesn't look that big in the portfolio. So that's why you need to have a longer tail of smaller cap stocks, which will happen over time.
Okay. Also, another thing that Street has always appreciated, I think, is the fact that your communication with unit holders has been very, very transparent, throughout, through and through. What's the latest that you're hearing? Since you are so much in touch with retail investors, what's the latest in terms of retail investor sentiment? How is it? Is it better than what you've seen earlier? Is it slumping a bit? And, what can we expect going forward?
I think so far so good. I think there's been some maturity with investors generally. I think last 1 year we've seen zero returns almost, right, in the markets, which would test a lot of people's patience. But in this last 1 year, we've not seen actually too much redemptions or SIP stoppages or any of those things. So it's holding fine. In fact, people are actually adding also. So we have been net positive every month in the last 1 year. So that's heartening to see. Obviously, I don't think a lot of people have seen a bear market or an elongated market where it doesn't go, So we had in 1990, from 1993 to 2004, we had zero return period, So that's obviously back in the day. So and we've not really had a bear market since 2007-8, right? I mean, the whole thing was buy the dip, and it's been working. Buy the dip has been working. My thing is that I think let's wait again. If this lasts for another year, then we have to see how people really react. But so far, I think it's fine. People are okay. Market's not like really gone down. It's just not gone anywhere. And again, I think communication, I think from everyone, I think if the whole industry has been good, that listen, generally the conversations are like, guys, we've had a good run, and sometimes it just doesn't go one way,
It needs to
sometimes
pause
you
at some point.
need to take a breather, I mean,
Yeah.
even if you run a race or something, you need to like slow down sometimes, and like it'll go. I mean, again, the whole also the communication generally has been that listen, this is a long-term product. Equity is a long-term product. don't go. I mean, you can't look at it from a 6 month, 1 year perspective. I'm hoping that at least some people have been following that, hearing all of us and seeing that, and people, you know what? People are like now investing for goals and all. Like, oh, I've got a goal 15 years from now. I want to buy a house. I want to buy a car. I want to send my kids abroad. I'll keep my sips going. I'll do a 20-year sip and all that. So that's great. And and the sip culture has come, which has really helped people to stay.
Yeah.
So
Yeah.
I think generally,
But
so
do you feel that this period, you spoke about that period between
yeah,
1993 and
yeah,
2004,
yeah,
right? Where there were no great
yeah,
returns for the
yeah,
market. It was
yeah,
just one long lull.
yeah.
Do you think we could be entering that stage?
I don't know. I think India is actually poised pretty well. So I mean, if you look at all the macroeconomic things and growth and demographics and all that is in our favor. It's just that the valuations are a bit higher. I think
Stretched.
once things normalize, or even if there's a 6 months, 1 year of no returns, then actually valuations will get more attractive. If there's a time correction. So I don't see, or I hope not, there is a long time correction or a very steep price correction. But yeah, you could look at a dull market for some time.
Okay, so last 5-10 minutes of the show, I just want to wind down. I mean, we spoke a lot about international investing, spoke a lot about the markets in general, but just want to get some thoughts because the show is called Money Mindset, and generally I notice that a lot of people who have built great brands over the years, who have been successful, have very distinct virtues, distinct qualities, right? Whether it is the quality of patience, perseverance, determination, whatever it is. What do you think you have done right in sustaining this brand for so long? Whether it is, when your father was there, post him, what all do you think went right for you?
I think what I inherited was a great foundation. So don't screw that up, right? I mean, the first thing is that I feel a lot of second generation entrepreneurs want to try to put their own mark and try to change too many things. But if it's not broken, don't try to fix it. So one thing I realized very early that, listen, we've got, I mean, a great foundation. All I need to do is compound goodwill and trust. Money will compound at whatever time it has to. But the main thing, I mean, you're dealing with people's money. The main thing is that trust and goodwill cannot be compromised from any other. Like, it just cannot. That's a reputational risk that you cannot take. Other thing we've done in the organization, which is a bit different, is that we don't have targets for any employee. No targets, no sales targets, none of those things. I think that's just led to a very collaborative organization because there's not internal competition. And we've said that, if the company does well, everyone will do well. It's not like we're looking at individuals. Uh, okay, you are a high performer and this is your target, and then you try to mess with someone else, or I mean, there's internal stuff. So one of the things is that it's a very collaborative organization and everyone from every department helps each other. Just the fact that nobody has targets, everyone just knows if the organization does well, we all do well. That's something that we really wanted, to have some human element to it, which also helps in having a work life balance as such. Because and people are happy, productivity increases, because I feel like if you have targets, then people are like thinking, even when they're sleeping at night, oh, how do I get my targets the end of the month, or what do I do, how do I sell this, who do I catch? I'm like, there's you need to spend quality time with your family, your kids, with your hobbies, and then you put in your 8-9 hours at work, and I feel like those are very productive if people are very happy back at home.
Yeah,
If you
yeah,
take
yeah.
out I want to take out as much stress from people as I can, and one big way is to not give targets and just talk. We were building trust here, so it's about, listen, it's the other person's money, we are just communicate what we are. There's no misselling or no lying about expectations or whatever. It's like, this is what it is now, it's the ball's in your court. I think that's helped, in some way or form. Like I said, it took 8 years. I mean, when we started in 2013, we reached our first 1000, we reached 1000 crore AUM in 2018. You tell someone today that in 5 years you would only be 1000 crore AUM, they would be like, you're probably the most unsuccessful person you should not be doing this, please change your career, kind of a
So
thing.
2018 you were 1000 crore AUM, and 2025 you're at 1 lakh crore.
1,40,000.
Wow, that
Yeah.
is
Yeah,
amazing.
so I think Yeah, but the other thing is compounding, right? Like I
Yeah,
said,
yeah, of course.
compound goodwill, compound trust,
Trust.
and money will compound, but it will take time, and then the patience come, because we tell people that have a long term approach, have like at least minimum 5 years investing in equities, say 5 7 years longer the better. And in our business also we have to do that. It's not like we are looking at every 6 months, oh, how have we grown. It's like it takes time. So even I think we, I think the way we run the business and the way we invest is actually very similar in terms of having those the longer term approach to things. So we're very patient people, I feel. So
There's one narrative. I mean, I don't completely agree with it, but there is a narrative that first generation entrepreneurs have more drive, have more, ambition to get to success, etc. And second generation entrepreneurs are generally a bit more laid back. They come from a place of deep privilege.
mm,
But I notice with you, it's not like that. I mean, you are almost like a first generation entrepreneur in that sense. How is
yeah.
that how has that been different for you?
Yeah, so I mean, so in a way, I did inherit, like I said, a great foundation. When my dad passed away in 2015, we were at 550 crore AUM. So and we started the AMC in 2013. Like I said, so that time we were the last one to get in at 10 crore net worth, criteria, where the criteria to get into a mutual fund was to start an AMC was 10 crores. After we got in, with the last people to get at 10 crores, which was changed to 50 crores. At 50 crores, we had 3 years to make our net worth 50 crores. Otherwise, we had to wind down, kind of a thing, right? I mean, so very early, so 6 months into launching the mutual fund, we had this thing that, okay, you have to be 50 crores. The easier thing is to have a JV partner or sell some stake or what have you. But that didn't really gel with what we wanted to do, because we wanted to run it in a very compact way, very few schemes, very less complications, where within one scheme you can do pretty much everything, and you don't need to launch 50 schemes. That was kind of the thought process, like a Swiss Army knife concept, one device multifunctionality. And that was like actually the first page of our presentation. It's like, this is a Swiss Army knife kind of thing. So anyway, so 50 crores we had to get there. So one of the things we did was we closed down all our other businesses, right? I mean, we had broking and distribution, and we had wealth management at that time.
You
PMS,
were
obviously,
broking
we
also.
transferred.
I didn't know
We
that.
had broking also, institution broking, retail broking. So we shut down all that stuff. We're like, this is something that we think has the best
Potential.
potential going forward. So we concentrated all on that. So that was like by 2014 that happened. By May 2015, my dad passed away. So in essence, it was only 1.5 years since we started this. So uh, I would say I did inherit a great set of values and foundation, and that was really great. But I think business, the actual 500 crores was not much to really work with,
Yeah.
at that time. So it was basically starting up fresh, basically.
Interesting.
So
Yeah, of course. I mean, going
yeah,
from 500 crores to 1,40,000 crore AUM
yeah,
is not a joke.
yeah. So
It's no mean feat, as they call it. So
thanks.
you want to wind down by just telling us some lessons that I'm sure you get asked this a lot, but what's your biggest lesson been from your father, both in life lessons as well as market lessons? I'm sure there have been many.
Hmm. So quite a few, yeah. He used to be. So I'll probably say a few lines that he used to tell me. The first thing is, don't work for money, make money work for you. And basically that is basically that. Everyone's in jobs, or you make money. Obviously, your job is to make money, but don't spend all that money. Keep some of that money and let that money work for you by investing, and that will compound and that will grow over time. So, so keep investing, because you're going to get rich only by investing. You're not going to be rich by just getting a salary as such. So investment is important. Compounding that money is very important. So do that. So and again, law of the farm. You also say that there's the law of the farm. That you cannot sow a seed today and hope for a tree tomorrow. Like, seed will have to go through various seasons, rainfalls, and you need to nurture it for it to become a full blown tree to give fruits. Similarly, it's with your investments. Don't have a short term kind of
Approach.
thinking to anything. I mean, think in decades, basically. Which is today is actually very, very important and very crucial to have that. I think going forward, that will be the main difference between people, because today Well, even Insta world, right? Like 1 minute reels and 2 minute Maggie noodles, and everyone's attention span is gone to I don't know what,
Yeah.
They can't see more than a minute, and cricket has become 2020, and now it's T10 also. Now they're starting. So generally, everyone's patience has gone down. It's obviously that you're bombarded with so many new products and new asset classes and crypto, and people are always want to make a quick
Quick
buck.
buck.
Yeah, so I think I think that'll be the comparative advantage going forward is who can do the boring stuff consistently over time, and I think those people will do really well.
And you've learned the art of doing the boring stuff consistently over
Yeah, so
time.
that's yeah. So yeah, hopefully you just do the boring stuff consistently over time, and that can hopefully get us somewhere in the
Okay.
future.
And finally, since our show is called Money Mindset, we always ask everyone, what is your definition of money? And what does money mean to you?
Money means freedom and time. I mean, beyond a point, money is has diminishing marginal utility as such. So after you reach a point, I think money just gives you freedom to explore and do things that you want to do, have experiences you want to do, and spend time with your family, which sometimes you don't have when you're working for money. So when you make your money work for you, you have all these advantages of actually just freedom of time. That's what money means for me.
Okay, that's amazing. Neil, thank you so much for joining us. It was really such a pleasure. And I can't believe we've never chatted before.
Yes.
We've never
Yeah.
met before.
Yeah.
But, on behalf of all the shareholders for whom you guys have created so much wealth, thank you so much. And I hope your journey continues.
Thank you so much, Sonia. I appreciate it. Thank you.